again, just, we're looking at kind of those education sides, that kind of products or tools to just be a better real estate investor. One of the things that you and I talk about quite a bit is just this cash flow calculator. So, as prices keep driving up, we're seeing a little bit of cash flow kind of sneak out of the market there. Just as things get more competitive, people are willing to take a little bit of a lesser return, just to secure a great asset. And I think that really kind of holds water when we look at just in that annual earnings review. We talk about that equity earnings and that return on equity. I think most folks would be surprised to see that really a lot of the times where their money's truly made is in that debt pay down. Are those conversations you're having with your clients as well?
Yeah, absolutely. I mean, when we started investing in real estate 20 years ago, we definitely weren't forecasting, 15 to 20% growth per year in the value of the property. Yeah. We were looking at these $250,000 detached homes thinking, okay, well, they might go up, 2% a year. Where you're really making your money is paying down the mortgage. We looked at it and said, okay, well, in 25 years, I'll own this house with no mortgage. And I mean, that was a pretty simple way of looking at it, but those were the numbers that got me interested in investing in real estate. Obviously, the equity growth has been strong, and it's been a reason to look even deeper into real estate as an investment. But I think at the end of the day, even forecasting where prices are now and where you see their trajectory, I think looking at the end of the day, knowing that you're going to own a home with no debt against it, and you've got that free and clear asset that you can turn into cash is probably the easiest way for you to feel comfortable in a path forward. Once you get into owning it, then there are obviously some other strategies you can look at, because I do think, leveraging or using a mortgage, leveraging a property is the best way to optimize your real estate. But for somebody who's just thinking, how is this going to look over the long term, just looking at the amount of equity that you're going to pay down is the easiest way to project. Real estate is a cash flow game. As you'll see, in the examples that we've got here on the spreadsheet, there's a fairly limited budget for maintenance and repair. And if you have to do a roof, a furnace, a kitchen, a bathroom, these are all things that need to be updated over time. That's definitely going to eat into your cash flow. But those things are then going to turn around and increase the value of the property. So anytime we're looking at cash flow being eaten up by increased maintenance and repair expenses, we're assuming that that's also matched by an increase in the value of the property. But the one constant you can count on is that equity pay down over time.
Yeah, I think so too. I mean, you can't eat dinner with appreciation or debt pay down, but I think looking at it from that principal investment perspective, that driving force of or your why you want to invest in real estate, that's something that's going to hold true at least for that 5-year fixed term that's often seen in mortgages, right? I mean, kind of coupling that with, a lot of banks, you look at Scotiabank now with their STEP program, they're looking at ways to allow Canadians to really put that equity to work as well. So I think the banks are really looking at more ways to have that value offering as well on that side. I think that's great stuff. When you're looking at a lot of this stuff, Dave, too, I mean, you're looking at your cash flow, you're looking at your debt pay down. That cash flow really is that insulation. It's kind of where you're making a lot of those changes, a lot of those renovations. But there's a tax benefit to that, right? I think that's the point that a lot of people kind of miss as well, is that when you reinvest in your real estate, there's an opportunity to kind of take that back at tax time. Do you want to kind of touch on that just a little bit, maybe if you're those more seasoned investors?
Yeah, absolutely. I mean, this is where a good accountant can provide you with advice to navigate around, tax law and looking at, expenses versus capital improvements. But yeah, that's where, looking at some strategies to I guess, reduce your profit so that, you don't lose cash flow to paying tax. And just really what you're doing there is deferring your tax payments until you're cash rich. This is usually when you're selling the property and cashing out. There's a tax bill there, but the longer you can defer it, the better. And obviously, working with an accountant throughout your duration of ownership there will help you implement some strategies to minimizing that tax burden when you do eventually have to realize a gain. But keeping the cash in your pocket is always the tricky part. And to your point about, kind of looking at 5-year financing cycles, usually what I tell my clients is, let's get in, let's hang on for 5 years. Maybe that involves doing a bit of the management yourself or hiring somebody else out at a rate that the cash flow can support, and also, deferring expenses for as long as you can until you've got the cash to support it. Once you can start going back into re-leverage the property, it opens up you get a lot more power from that, even if it's just taking a $10,000 refinance from equity that you've already paid down, and just leaving that as a slush fund, so that if you are cash tight, you do have a bit of a buffer there that is usually enough to solve all your problems and alleviate any stress or any risk there might be in the investment. But again, over the long term, we're not looking for these properties to generate as much cash on a monthly basis as we are looking at the ability to redeploy equity that you've paid down over time. And obviously, when you do come to disposing the asset, that's where you're coming to your largest amount of cash, which again, hopefully you're redeploying in real estate of some kind, or I guess any investment that's going to have a decent yield. But real estate still seems to be a good piece for anybody's portfolio.
Yeah, I think that's a great point. I mean, you touch on that redeployment of capital as well. One of our key drivers and a lot of what we're looking at is that cash on cash return. So until you can really pull that capital back out and redeploy that, we're still looking to have that fundamentally sound. But once you pull that equity out and redeploy it in another property, your return almost becomes infinite. If you're putting $130,000 down on a property, waiting 5 years, and then pulling that 130 right back out and redeploying it, that same asset that you bought the first time, that return becomes infinite, right? So looking at that from a principal perspective, I think that's a great point, Dave. Really do.
Yeah, totally agreed. I mean, the longer you own the asset, too, generally, you've seen some price growth. You've also seen your rents grow, and your mortgage expense generally over time, as you're paying it down, that expense is going to shrink and go in the inverse direction to your revenue. So that's generally a pretty healthy business model.
Yeah, totally agree.
But and in terms of using your real estate to kind of invest or diversify into either other real estate opportunities or anything else that might suit your financial position is probably it's one of the biggest benefits of investing in real estate.
Yeah, it's that leverage, right?
Yeah, and I mean, one piece on this, and we're kind of going off on a tangent now, but I would say that I have talked to some people who purchased a home maybe 10 years ago, and they've been in the house for 10 years. They've watched it double in value. Their mortgage might have started out at $200,000, and they've chipped away. And hey, we only owe $50,000 on our $600,000 asset. The problem there is, if you look at what a total percentage of their net worth would be, if they've got $500,000 tied up in their personal home, and they don't have any other investments outside of that because they've been deploying all the cash into the mortgage. Well, I mean, personal house is going up in value, so you're getting a return there, but you're going to get that return there even if you have a mortgage. Whereas if you had a $400,000 investment portfolio that was earning you 6 or 7% a year, now all of a sudden you've added $28,000 a year to your income, and diversified at the same time, and you're still getting the growth in the value of your house the way you would if you had no mortgage, but you've also got that diversified, be it in non-registered investment account or tax-free savings account, RESPs, RSPs. Again, that's where everybody's personal situation kind of can change the direction, and why everybody's going to want to kind of look at this through their own lens. But that's a really big piece of the power of real estate that I think people are starting to take advantage of more now, as we see mortgage products and mortgage interest rates really competing for buyers, and making refinancing and leveraging your own equity a smart financial decision.
Yeah, no, I think so too. I mean, you spoke about it before as well, but really talking to your accountant and doing what's best for you. But I mean, looking at it from that real estate professional capability, where you can offer that real estate investment management side, where you're talking to your clients about that piece, coupling that with the use of a team like an accountant or a great mortgage broker. I think that's a great 1, 2, 3 punch again. We're really using real estate, in all the ways it can really benefit folks.
Yeah, absolutely.
Awesome. Great stuff, buddy. All right. Well, again, great chat. We'll park this real estate cash flow calculator to another day. But thanks as always, David. We'll talk to you soon, buddy.
You bet.